Welcome to this lecture on this rather depressing topic that is all too familiar now in the press, recession. Although some press would have it that a depression is coming. And they mean a depression in the economy, although undoubtedly there will be depression in mental health, probably throughout the world. However, this lecture is called recession. A recession is defined as 2 consecutive quarters of negative economic growth. Yes, it's another lecture about the economy, but as with the others, we're not only going to be talking about the economy, because what happens in the economy affects businesses, consumers, households, schools, government spending, tax rates, interest rates, but also confidence in business, confidence in consumers, and confidence in leadership. So, a recession, 2 consecutive quarters in negative economic growth. And what are the causes of a recession? Well, we can whistle through them, rattle them off really, because we know what the cause of this recession is. COVID-19. Or to be more precise, the government reactions, probably Sweden notwithstanding, to COVID-19. Nevertheless, a recession may be caused by a loss of confidence in investment and the economy. Me, as a business, I will not invest in the economy if interest rates are high, making borrowing expensive. But also, and probably more importantly, I won't invest unless I think I will get a decent, high, middle, confident return on my investment. With demand falling throughout the economy, with money spent on shopping declining, except for essential goods and alcohol, but certainly expenditure on restaurants, clubs, pubs, hotels, the leisure industry has fallen. Houses in the UK have already fallen, some say, in terms of price, by about 16%. Will I buy a house now? Or, reading the press, knowing that furloughing in the UK is going to continue until October, why not wait a bit and watch the house prices fall even more? So, confidence about investment, high interest rates. High interest rates will encourage you and me to save. Of course, that assumes we have income in the first place. But if our incomes are falling because we've lost our job, we're racking up the debts because we borrowed all this money, then we're not going to be saving. But certainly high interest rates will deter investors. They will also make exchange rates. That's high interest rates will make exchange rates higher. Export prices rise. Import prices fall. Import prices fall, we buy more imports. More money leaves the economy. Export prices rise, less money comes into the economy. Another factor is the stock market crash, or a stock market crash. The sudden loss of confidence in investing can create a bear market. A bear market is where I think prices are going to fall, and so they do. And because they do, that reinforces my thoughts, and I think they will continue to fall, and so they do. So, a stock market crash, falling house prices and sales, manufacturing orders slow down. If you study economics, which you may not do, you would know that a fall in income elasticity of demand, is likely to lead to a fall in demand for manufactured goods. You don't buy the goods, I don't make them. I don't make them, I lose my job. I lose my job, my income goes down. I don't go to your shops, your restaurants, etc., so other people's income will also fall. Poor management, bad business practices can cause a recession. For example, the savings and loan crisis in 1990. More than 1,000 banks with total assets of $500 billion failed. Why? It was a result of land flips, questionable loans, and illegal activities. Wage price controls can cause a recession, a price cap, a wages cap. For example, if I restrict, I'm the government, if I restrict wages, maximum wage cannot go above this level. That can deflate demand. Demand falls, aggregate demand, consumption falls. Demand for products fall, people lose their jobs. In terms of wage price controls, this has only really happened once in 1971. Richard Nixon, or President Richard Nixon, froze wages and prices. He said prices can't go up in order to stop inflation. But employers laid off workers because employers couldn't lower the wages. So prices weren't going up. And if wages continued to rise, then the profit per item, or the contribution, would fall. Demand fell since families now had lower incomes because employers were laying off workers. Companies couldn't reduce prices, so they laid off still more workers. Companies couldn't raise prices, so the contribution was less, so they laid off still more workers, and this caused the 1973 recession. Post-war slowdowns. The economy slowed down after the Korean War. This caused the 1953 recession. Similar reductions after World War II caused the 1945 recession. Then, of course, there's the 2008 credit crunch, when Bear Stearns announced losses thanks to the collapse of two hedge funds it owned. The funds were invested in collateralized debt obligations. When Moody's downgraded its debt, banks which were in a similar over-invested condition panicked. They stopped lending to each other, and that created a massive credit crunch. And then there's when asset bubbles burst. Asset bubbles occur when the price of an item, such as gold or stocks or housing, become inflated beyond their sustainable value. The bubble itself sets the stage for a recession to occur when the bubble bursts. Deflation. Inflation is a rise in the general price level. Reflation is when there's a boost in the economy without a boost in prices. Deflation is when there's a fall in prices owing to a decline in economic activity. So prices falling over time have a worse effect on the economy actually than inflation, because deflation reduces the values of goods and services being sold on the market. What's going to happen? Prices are falling, so I won't buy now. I will wait. I'll wait for them to fall a bit further. For example, maybe you've seen this course at $180 and you thought, what a bargain, and quite right too. But you decided to wait until it was $30. And then you thought, that's an even bigger bargain. But you decided to wait. And then you saw it was for sale for $9.99. Now, instead of waiting for a promotional email where the price was perhaps lower or this course was bundled with other courses, you snapped up this course at $9.99. I'm assuming. Perhaps not. Perhaps you got a free coupon. But if you did, it wasn't from me, at least not directly. So we have the main causes of a recession.